Hey everyone, I hope everyone is doing well and a happy weekend to everyone. So, I thought I'll just talk a bit about cash flow from operations and its relation to the growth of a B2B company. So, fundamentally, I wanted to discuss a disparity in treatment that happens when we are focusing too much on cash flow from operations and cash flow from investment activities, right? So, fundamentally, what happens is that any kind of fixed capital creation or capex done by the company gets accounted for here. So if imagine if a company wants to buy assets, plants, machinery, land worth 100 crore, that would all come in cash flow from investment activities, right? And this would have to be eventually funded through the cash flow from operations, right? So you can see that a company that is creating fixed assets funds it through cash flow from operations, right? Now you can imagine that for some companies, creation of fixed assets is not as important as investments in working capital, and we'll come to that eventually. But the thing that happens is the investments in working capital, which is receivables and inventory, happen inside of the CFO calculation, right? Because the way it gets calculated is you start from operating profit or profit from operations, and then you subtract receivables, you subtract inventory, you add payable, you subtract taxes paid, and basically then you get cash flow from operations, right? Essentially all the working capital changes have happened inside of the cash flow from operation calculation. Effectively what that means is that if a company has to extend its working capital, sort of expand its working capital, then the CFO sort of gets reduced. So you can imagine that there are two companies, right? I'm an entrepreneur. I have two options, right? One option is I extend my working capital cycle, and through that I'm able to sort of strategically fund my growth, right? And we'll come to why that happens. Or I can create fixed assets and through that fund my growth, right? And every company will generally have like a combination of these two capital allocation decisions, right? And without taking names, one of the recent IP product company, IT product company talked about this, that we use working capital as a strategic lever for growth. What that means is we will keep inventory of hardware products so that we are able to give it to our customers when they need them, and also we will extend favorable paying conditions, or basically extend receivables so that we are able to grow faster, right? So that those are sort of choices which entrepreneurs have. But now imagine that there are two companies. In one company you have CFO equal to 100 crore, and then your cash flow that is going into investments is minus 100 crore, right? In this case, eventually nothing comes out of the company, right? And I mean there's no free cash flow, right? But the cash flow from operations is 100 crore, so you might feel really good about it. Okay, cash flow from operations is getting generated, right? Versus that, now consider a company where cash flow from operation is zero, and cash flow from investments is also zero, right? Now here it is possible that in this zero there was a 100 crore profit, operating profit, and it got all sucked into working capital, right? The only thing I'm saying is shorthands like EBITDA to CFO conversion are sort of neglecting this nuance, that there are two kinds of capital allocation that companies can do, and they have to do some combination of these. So now coming to why does it happen that a lot of B2B businesses have a poor working capital cycle. So of course the North Star metric for us is a kind of company which is able to grow fast without stretching its working capital cycle, right? Those are the best kind of businesses. And even among the ones I own, there are some companies like Shivalik, and of course none of this is a buy and sell recommendation. This is all just for discussion. But Shivalik was able to do pretty well in 23, and I think it generated like 60 crores of operating cash flow, right? That's the ideal thing for us because it's not stretching its working capital cycle. But in a lot of cases, imagine if the company has to grow 100%, right? And these are like, we are mostly talking about manufacturing companies and B2B in India. 100% growth year on year, right? You have to, number one, keep raw material inventory. Then there will be work in progress inventory for things that you are A, constructing, B, that are en route to the clients, are on the ships, and so on and so forth. Right? There's work in progress inventory, and then there's finally finished good inventory, right? So there's a combination of these inventories which companies have to keep for that 100% growth. So I think one thing which I think investors have to do is be mindful of this, that all of poor cash flow from operations is not necessarily a bad thing, especially for a single year. We have to look at it in chunks of year, what happens over 3-year periods, right? The other thing we have to do is we have to ask the entrepreneur that, okay, you are saying that my working capital is stretched because it's stuck in inventory. How will you fund the growth, right? That's what you have to ask them, finally. Lastly, I do want to add that for a lot of these companies, this is like a strategic decision that they take, that let us sort of make this a little looser that will allow us to grow fast. At the end of the day, what we can do as investors is, whenever the annual reports come out, we have to check the schedule to the statements to figure out how that inventory is sort of stacked up. Is it mostly finished goods, which is a bad thing, that why are you holding inventory for your client? Or is it mostly raw material, which is still okay, that you can say that I want to buy inventory for my future growth, right? And work in progress, of course, you have to hold inventory. And for receivables, we have to see the aging of the receivables in the notes to the accounts, that is it mostly the kind of receivables which are too old, like 1 year old, 2 year old, or are they mostly current receivables from the last 90 days or 180 days? Those are the best. Finally, we have to see impairment to the both the inventory and the receivables. So I just thought it will be good to share this, because there's like this dichotomy, or there's this kind of a different treatment for capex and for working capital investments, and both are important for a business. So I think we have to look at it from a business lens, apart from or in addition to looking at it from a accounting lens.